Mid-year market update. Economic data, not so good. Stock market went up. Now we're starting to see some issues. Of course, you've got the Fed, the president, and his cronies pushing this, trying to do something every day.
Do something! Do something! Do something!
But is it enough? It's going to be a bumpy next couple of months. We're going to explain why and give you a game plan. Sit back and let's go. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links on today's video. Also, if you're looking for a different opinion, that of Wall Street and Big TV, hopefully you are, please do consider subscribing and liking today's video. Also below, registration link for a live mid-year event. Have a couple great speakers. Hopefully, we will see you there. Today's agenda, as always, big charts, lots going on here. Sector spotlight. A lot more going on here. What keeps me up at night? All this data and upcoming data for this quarter. Last but not least, what is our game plan going forward? Let's go to the big charts. All right, first up, as a reminder, our process consists of a few items. Number one is the charts, which is called technical analysis. We look at the momentum of the charts. Then we look at the cycles, where we are in the cycle. And then we look at the economic data. But we always confirm with the charts, especially on the short term, on our decisions. We'll talk about that in a minute. So first up, monthly view. What has changed? Nothing, okay? The biggest thing, again, this is called relative strength up top, and you're seeing a series of lower highs. That's called negative divergence as we've gone up. Also, we are still in a negative crossover from a momentum standpoint. So right now, our monthly view continues to be negative. Now, on the midterm charts, we had some changes last time. This is our 40-week. This red line there is our 40-week moving average. We went above. We broke it last Friday to the downside, and we hovered around it yesterday. We'll see what is going to happen here. And then the other thing is, when it comes to momentum, we're starting to see a series of lower highs, still positive, but as you see, maybe if Andrew zooms over, starting to bend over a little bit. So right now, it is positive, but I'm a little bit of a neutral bias. So the biggest thing we're seeing right now is on the short-term charts, which are daily charts. Lots going on right now. So a couple weeks ago, we mentioned this, right? We have what was called a gap up and then a gap down. What that led to is called an island reversal. Love these terms, right? And then, of course, we have kind of started this little cluster here of really not going anywhere. We broke our 200-day moving average once. We broke it a second time, and we're hovering on it as of yesterday. So, again, a lot of breakdown here in the short-term charts. So when we look at the charts, it's going to be price, volume, volatility as we look at things. So here is, let me go back up so you can see this. So last Friday, we had a big down day, right? Which is right there. Big surge in volume, right? That is not a good sign. So yesterday, the market's up 1.4 whatever percent, and look at volume. That is 27% less than Friday. Again, price, volume, volatility. That is not a good sign. And then the big thing continues to be that the VIX, the volatility index, continues to be above 30. Okay, that's a problem. Remember, when we're above 30, you got to be careful when it comes to buying new asset classes, okay? 25, 30, you're trading, and then when it goes below, it's better. And then, of course, here we had a definitive negative crossover, okay? So our short term, took a little while for me to get here, our short term is definitely negative, okay? Now, that's the S&P because everyone talks about that on TV. This is the NYSE, which is the broad market. Just want to show you this. We're still down 20% from our all-time highs. That's obviously a bearish sign, okay? So the next one, we look underneath the hood, what's happening. Same thing, NYSE in black, it shows you what's going on. And then new highs minus new lows, blah, nothing. There's no surge happening. I mean, yesterday on a big day, you had net 44 new highs minus new lows. So you're just not seeing the push underneath here. Now, the question is, where are we on the markets as far as pricing? Are we undervalued, fairly priced, or overvalued? Well, it just updated, so a couple things, okay? The red is 20 PE, okay? The cake, cyclically adjusted price earnings. 15 is fair value in the long-term average, and 10 would be undervalue, okay? So as of yesterday's close, if we were to get to 20 on a PE, that's minus 24% based on projected earnings for this quarter. That is not a good sign. How about 43% for fair value at 15 PE? So not saying we're going there, but this market has been way overvalued. Reality's coming into this quarter, right? When I talk about a bumpy ride, okay, this is my biggest concern right here. And then let's talk about the bonds. They always say the bond market is smarter. Look at what's happened from our last video. We hit the high end of our range. We actually doubled our position here, has worked out well. And guess what? We have broken a trend line. I mean, as of yesterday, we're down to 0.64 on the 10-year treasury, okay? And continues to go down. Same thing. This was a big one. So we've broken trend on the 10-year and also the 5-year, which is in blue. 2-year next. Again, none of these are good signs. It's signs of the Fed flooding the market and people going for safety. Next up, Sector Spotlight. All right, Sector Spotlight, as always, one of my favorites, gold, right? Everybody loves gold. So I've gone back to fourth quarter of 2018. Why is that important? One, that's when we started adding gold, but two, that's when we peaked with earnings. Yes, everyone seems to forget that. So you have a consolidation. We added in late fourth quarter there. You have a breakout, you consolidate, breakout, consolidate, breakout. Then we had, of course, the March mess when people were raising capital, had a liquidity crunch. So we got hit pretty bad there. Then again, we come up and we consolidate. But guess what? Another breakout. We are at an 8-year high right now. Still love gold going forward. We happen to be tapped out on our allocation here, max allocation. And the other thing we look for, right? Obviously, price, volume's been good. Look at volatility, and it spiked. And as of this morning, it's gone below 20 gold volatility. So everything's setting up nicely. If you're not in gold, you wait for pullbacks or consolidations. Okay, we've talked about this. Commodities index, okay? Going down, dollar down, inflation up. We'll get into that more in a second, but we're starting to see a move here. So I started adding to some of those inflation, stagflation type asset classes. I'll show you one right here. Okay, again, there's your dollar peak. US dollar's down here, and it's gone straight down. Okay, what happens? Okay, and that comes from the Fed really pushing, okay, to devalue the dollar. So with that, inflation rises. Here's copper. Couldn't be nicer, right? This is actually a 20-day moving average, which I use for short-term trading. So for me, again, I look to get in on downs. So when it's red, you buy on red, you sell when it's green, but this is setting up nicely. Kind of looks like, whoops, let me get rid of that. A nice little cup and handle right there. Okay, so copper is one of 3 or 4 inflation asset classes that I'm currently adding. You got to be careful there. You don't see a lot of volume, so you want to make sure you do your research on that. Next up, these are some of those cycle 3 asset classes that I'm getting worried about. We've gone neutral on staples, so on a green day, up almost 2% yesterday, took some profits, reduced my allocation. Same thing on utilities, right? Here we actually broke trend. I still like it in this cycle, so I'm going to let it breathe and see what happens. Obviously, we had a nice day yesterday. Rates are down. Both of these, right? They work well in a low interest rate environment, okay? So, next up, what keeps me up at night? All right, so what keeps me up at night? I always start with the cycles, okay? We were in cycle 4 until a couple weeks ago. Growth slowing, inflation decelerates. Remember, the dollar went up, okay? So we were in the dollar when we were in cycle 4. Fed is dovish, market's kind of deflated. But what's happened is we have moved now to cycle 3. Growth slows. Trust me, you're going to see it with earnings, okay? Inflation accelerates. No doubt we're seeing it with some of those commodities, okay? We like that. Fed neutral, pretty much. We'll show you that. Market stagflation. And people have asked, what can you compare this to? Not saying they're going to be the same, but the 1970s, okay? You had high inflation, stagflation, etc. So each of these help make decisions for us and create opportunities in asset classes, okay? So if the dollar goes up, you own the dollar. Guess what happens here? Dollar goes down. We short the dollar in this cycle. So first up, of course, the big story continues to be unemployment, okay? But what is the full story, which you're not really hearing on CNBC, although I was surprised to see this yesterday. Nearly half of U.S. population is without a job. Just think about that for a second. It's just devastating, okay? Now, when you look at the numbers last week, you don't see this. I didn't talk about this because I always watch on the Thursday morning what the numbers are. So this is exactly comes from the government. I'll put a link below, okay? So here's June 20th, and what do you see? 1,480,000. That's the number that they gave us, okay? The other number they gave us is 20 million. Okay, and that, of course, represents about 13% unemployment. But, a big but, okay, they're not giving us this. Initial claims filed in federal programs. So they came up with the Pandemic Unemployment Assistance Program for self-employed folks, individual contractors, etc. We had 728,000 last week. So the true total last week was $2.2 million, and we're at 30 million continuous claims, not the 20 that they're talking about. That really puts us in the high, right around 20% in unemployment. It doesn't feel good, but that is reality. Savings rate, we've talked about this. It spiked, and now it's coming back down. Why? Because people have been in the program longer. Okay, they're getting extra money for unemployment. Money's getting tighter. They need to use that to pay for their bills. Follow the money. Follow the consumer. So this is data directly from OpenTable I'm able to get. Okay, United States, seated diners. Look at that trend rate there, right? This is 6.7 through 6.22, right? We're talking about minus 60-some%. Okay, and this is global. I mean, look at United Kingdom, minus 99% reservations. Okay, 628, we're minus 60%. We were worse, we got better. And as coronavirus cases get worse, that number goes up. That is not good for the economy. So again, that creates rising delinquencies with the consumer. You can see the trend, okay, on the mortgage up to 8%. This all ties together. Here's our Fed. We've talked about this several times, but if you look up here, you kind of see a little bit of a button hook. They slowed down. They stopped purchasing. Oh, by the way, what's happened to the market since they've done that, right? Go back to that part of the slide, and we all know that the market has gone sideways here. So we've talked about it again. Liquidity is what they're trying to do. They can't help with solvencies of companies, okay? You're looking here. This is Chapter 11 and Chapter 7 soaring, unfortunately. So that big disconnect between the market, okay, and Main Street, you can see it here. It's coming, folks. That's why I say it's going to be bumpy. And how about this? U.S. credit rating downgrades. Hello? Remember 2008 and they weren't reporting it? Look at the surge here. Unbelievable. Okay, on a weekly basis, over 500 credit downgrades. That is the sector I'm watching. High yields. We're going to start seeing this break down. This is a big issue we're going to continue to watch. Whoops. Okay, game plan. What's next? Let's start right here, okay? From our friends at HedgeEye, that's a V, right? We know we're not getting that V. We've shown this before. I don't know yet, okay? Is it going to be a U or a W or even an L, okay? It's not going to be a V, especially with the surges in new cases, okay? So the big issue right now, millions of Americans will fall off the income cliff. The reason I say it's going to get bumpy this summer, again, earnings are coming out. You're looking at 24 to 30% down. GDP minus 45%. This is the big thing. Everybody was getting an extra $600 in their pocket. That's going away. It's going to dry up. Will they come out with more programs? We'll see. Not going to get into the politics of that. We'll talk about that at our mid-year event. But that's another reason. So we always talk about what's your number? How much can you handle? Find opportunities downside and upside. Look, you could be long the market, okay? I'm long gold, meaning I own gold, and short in other sectors if you have the skill set to do that, okay? So right now, I only have one short on. I'm waiting, but I will probably start shorting more sectors if the volatility index continues to go above. Of course, follow us for updates on our social media platforms, putting stuff out daily. Hopefully, we'll see you at mid-year. Thanks so much for watching. Michael Loftus, Wealth and Wisdom TV.